Just to add something to what Dorina was saying about the muni bond market and the extent to which it's influencing public-private partnerships. We'll come on to talk about private activity bonds, which are a species of tax-exempt financing. But I think it's important to note that municipal tax-exempt debt has actually prevented or slowed the development of private finance in the US. And the reasoning is, if you have a tax-exempt coupon on the debt, that means it's going to be cheaper debt. Your all-in interest costs are going to be lower. So governments in the US, which are primarily responsible for transportation, operation, and construction, look at the weighted average cost of capital of a project financed by tax-exempt debt as compared to a public-private partnership. And the expectation is that, and it's a reality if you look at it very simplistically, it's much more cost-effective to issue tax-exempt debt than to have an equity contribution combined with private debt, where the weighted average cost of capital could be somewhere in the neighborhood of 7 to 8%, whereas a tax-exempt coupon these days on muni debt is in the 4.5–5% range. So government officials see that financing pricing advantage with tax-exempt debt, and that has presented some challenges with respect to the growth of private finance in the transportation market.
Now, in addition to the benefits of the muni bond market, there have been limitations. Oops. Some of the limitations focus on who the issuing entity are, actually most of them. The issuing entity does need to be, the way the program works, it does need to be a governmental entity. And as a result, all the financing and repayment risks sit with that public entity. In addition, the operating and construction risks also sit with the public sector. And as we all know, as we've all watched public-private partnerships develop, the core there is to bring the expertise of the private sector into the infrastructure market and help develop and create more efficient structures from all perspectives. And as a result of recent credit events, financial crises and the like, the problems with the credit crisis affecting directly governmental entities started to have a negative impact on the muni bond market because they became less attractive investments given the risks that were associated with the ability of the public sector to pay back some of these bonds. As a result, we saw the direct development and growth of the more traditional long-term project finance debt market. It was seen as an alternative source of financing, and it was seen as a way that the private sector could leverage off of the experience of the the public sector could leverage off of the experience of the private sector, both in terms of efficiency and in terms of capital. Investors, such as commercial banks and other financial institutions, look to the project assets and the revenues it generates, not the sponsors who are developing it, and in some cases, less to the government entities that are procuring the projects. As Ken has mentioned, we'll get a little bit into the concession pricing models, which will show how some of that risk can be managed. But the key is that you bring in the expertise of the private sector and allow the public to leverage off of that and grow the financing options for the market. Now, when we look at the types of projects that are developed using long-term project finance debt, there are two typical kinds. The first is brownfield projects, which effectively means that it's an already operating asset. Therefore, there is some history in terms of how it operates. For example, in the context of a toll road, you have an experience seeing how tolls are collected and how much demand there actually is for it. And that provides monetization options for the private sector in order to build off of that road or further expand it, and also generate some revenues for the public sector. The other option are greenfield projects, meaning that it's a project that doesn't exist, there's no prior history, So people who are looking at banking the project are banking the future possibilities of growth there. And at the core there is really the interrelation between the public and the private relationship, and how the private entities with more experience can help build that road or build that hospital. As we've described, there are a lot of benefits that the private project finance banking market brought to help alleviate some of the concerns and some of the credit issues with the municipal bond market. However, it wasn't easy going from the very beginning in terms of developing the infrastructure market in the US through the long-term project finance structures. The biggest challenge is that, as Ken has mentioned, this is fairly new in the United States, and despite all the hype and the excitement about developing the US infrastructure market, it actually took quite a few years to really see the market develop and advance. There was a very high learning curve because traditionally public sector entities were accustomed to having bonds issued, proceeds come in, and doing whatever they needed to do. They weren't as accustomed to the customary, what many of us see as the customary project finance structures. As a result, the procurement periods for a lot of these projects were very long. In addition, there was a reaction from the people who were going to be told all of a sudden, because they're used to having free roads, which in many cases is considered a very customary approach to travel in the US. With the credit crisis, we also saw that private funding was actually affected, and as a result there were funding gaps. And most importantly, even though commercial banks and financial institutions are very accustomed to structuring typical public-private partnership transactions and taking a commercial approach to some of the structuring issues, the reality is they also find themselves with funding issues, and long-term finance started to drop. And it became more common to see what we refer to as mini-perm structures, which are actually shorter-term loans expected to be repaid 7 to 10 years out. However, the amortization schedules are modeled on a 30-year or so repayment profile. As a result, there was significant refinancing risk. But as now Kent will talk a little bit about some of the structures that have helped smooth those risks out, the solution has increasingly become a capital markets takeout solution, so that you can appreciate the long-term benefits of some of these concession contracts.
Okay, so as discussed, I'm going to focus on two programs in the U.S. for federal credit assistance that has really been the driver, one of the key drivers to the growth of public-private partnerships in the U.S. The first is the so-called TIFIA loans. TIFIA is an acronym that stands for Transportation Infrastructure Financing and Innovation Act. It was a federal statute that was passed several years ago. It was renewed 2 years ago with the enactment of the latest Surface Transportation Reauthorization Financing Bill. And the key thing about TIFIA is that it's subordinated debt at a very cost-effective coupon. That combined with private activity bonds, the so-called PAVs, have provided a low cost of finance to public-private partnerships, which has, in the minds of public authorities, provided a more cost-effective financing solution for a public-private partnership, and one that is competitive with traditional tax-exempt muni debt. If you remember, I said a few minutes ago that one of the challenges in the US is because the municipal debt market is so well developed, there is a mindset that is taking hold, which is that why would I ever get private debt if I can issue very inexpensive and flexible tax-exempt debt with a lower coupon? Well, these two programs essentially address that question. How can private finance compete with traditional muni debt finance and provide an opportunity for the private sector to finance infrastructure projects? So we'll talk about both of these products in a little more detail. TIFIA is a program that is a credit guarantee of debt provided by commercial banks, or more commonly, it's a direct loan provided by the federal government. It's provided by the Department of Transportation. The tenor of the loan is a maximum of 35 years, so it's very long-term debt, which is important in a concession context because the longer term your debt is, the more cost-effective your financing is. And it's subordinated, but it's subordinated with an asterisk, and I'll explain what that means. In cash flow terms, the repayment of the TIFIA debt is subordinated to senior debt. So if during the course of a project there are insufficient cash flows to meet operating costs, to pay senior debt, and to fund reserves, then the TIFIA loan can go unpaid for a period of time. So it provides liquidity support, it provides sort of a grace period if there are difficulties in terms of revenue ramp up for these projects. However, there's an important qualification to this subordination, and that is it is subordinated only in cash flow terms. It is not subordinated in bankruptcy. And that has been one of the main criticisms of the TIFIA loan program. If there is an insolvency or a bankruptcy, what happens is that TIFIA goes from a subordinated creditor to a senior creditor. It's the so-called springing seniority for TIFIA loans. And as a result, it means that if you're a senior creditor in a bankruptcy, you don't have a cushion of subordinated debt behind you with TIFIA. What you have is basically a creditor that is pari passu with you. And so that is a major limitation on the use of TIFIA debt. Nevertheless, it is extremely cost effective. It is very flexible in its terms, and it's more or less standardized. So there is not a lot of execution risk or extensive negotiations that go along with the TIFIA loan. They have standard form loan documentation that's been designed to sit alongside private finance. Not only is it designed to sit along private finance, but one of the requirements is that a TIFIA loan cannot make up more than 49% of the total sources of funding for the project. So it's by design a co-financing product that's provided by the federal government. Now, why is this interesting for Colombia? Well, I think it's potentially interesting for a program that we understand FDN is considering providing to the 4G program in the form of subordinated debt. We heard in the last session Manuel give a very clear explication of the problems with subordinated debt under Colombian law, so there would be some challenges potentially to taking the TIFIA program and trying to implement it within FDN's structure and under the Colombian law treatment of subordinated debt. Nevertheless, if contractual subordination can be enforced in Colombia, and we understand that it can, although there are some uncertainties, we think there are some benefits to for FDN to looking at TIFIA because it's been a very successful program. And it's really enabled a lot of projects to go forward in the US that otherwise wouldn't have gone forward. The second product, private activity bonds, so-called PABs. Now, PABs are a species of tax-exempt financing. Dorina described to you the traditional muni debt structure where the coupon on the debt is exempt from federal and state taxation, but it has a very serious limitation. It is not available for private use. And what private use means is that traditional municipal debt cannot finance a project where there is an equity investment from the private sector. So therefore, municipal debt historically was only a public finance technique. However, recently, the federal government has expanded tax-exempt debt to private projects where equity is invested. They disapply the private use exemption. And so PABs are tax-exempt debt issued by what's called a conduit issuer. You still need a government issuer, but the proceeds of that debt can be used to finance a project which is developed by the private sector. It's created a remarkably powerful financing technique for public-private partnerships in the US, especially combined with TIFIA. Because now you have two products provided by the federal government that basically level the playing field between the traditional municipal debt publicly financed projects and a public-private partnership, because the cost of debt between the private project and the public project are not all that different. And once you eliminate the differential in financing costs, a public-private partnership then becomes extremely appealing because of the other benefits it brings along, both in economic terms and also just in quality of operations and the services that are provided through the infrastructure that's being built. The limitations with PABs at the moment are that it's capped. There is an allocation of $15 billion, so there will be a need for the federal Congress to enact a new law that will provide an increased allocation for PABs in the future. In addition, the federal government is also considering expanding the PABs program through the use of so-called qualifying facility bonds, which will be PABs, but they won't be subject to the limitations on allocation that currently exist with respect to PABs. I think the final point on PABs especially is that it's a capital markets financing. And as Dorina said, in the US, everything eventually goes to the capital markets. Bank debt for infrastructure, with a few exceptions, is very much seen as almost a bridging technique, where you have a mini-perm loan that's provided on a short-term basis, which will provide financing that is extremely flexible and very suitable for construction. But because of tenor limitations, you can't go out the 20, 25, 30 years, which would be necessary to provide really cost-effective debt financing. And that's where the capital markets come in. Once the bank debt has been provided, the project has been built, then immediately the project sponsors look around for a capital markets takeout of the bank debt. And PABs provide a very powerful tool to take bank debt or projects financed by bank debt and refinance them in the capital markets.
And one thing I was going to add as well is the typical structure we're seeing that Kent has just described, where you have the short-term bank or financial institution debt taken out by the capital markets debt, helps deal with the final issue on the slide, which is the negative carry issue. Because you are typically issuing your bonds one time in the capital markets, and you may not necessarily need all the debt up front if you're constructing a greenfield project. You'll need it over time. If you borrow everything up front, then you have to pay interest on all of it, and that adds a cost to the project. Therefore, the takeout solution does help mitigate that issue.
It's actually an excellent point to focus on just for a couple of minutes here. The benefit of bank debt is that it has a delayed draw function, which means that debt is drawn only when the capital is needed to make a payment for construction. Otherwise, commitment fees are earned on the debt, but you don't have to pay interest on the debt, whereas in the capital markets, all of the debt is issued up front, interest begins accruing on the debt from the date of issuance, and so you have essentially an additional cost that has to be borne by the project through the negative carry. I think the combination of bank debt and capital markets debt in the US is an interesting model, and I think one that is potentially very suitable for Colombia. Colombia has a very strong commercial bank market. Commercial bank debt is very flexible and therefore very suitable for construction. Commercial lenders have a better ability to monitor construction, to deal with change orders, to provide basically an immediate response to problems that may come up during the construction period. Whereas capital markets debt, because it is so widely held and the institutions that buy it aren't really equipped to monitor construction, are criticized as a construction financing technique because the flexibility just isn't there. So in the US market, there are a lot of projects that will start with a construction loan provided by commercial banks, and then when the project is completed, then that construction loan gets refinanced in the capital markets. And one could see that developing in Colombia, especially the advantages of bank debt and the delayed draw facility, which doesn't really exist with capital markets, with the exception of some limited delayed draws for private placements.
So that was our first lesson learned that we wanted to talk about. Now we're going to move on to our next, which is addressing construction risk through concession pricing models. What we're going to do is we're going to walk through 3 key pricing models and then one add-on, and then look at how that compares to what we've seen in the 4G model that is currently in the market to be banked. And you've heard a lot of discussion today about how to encourage international investment, both from the developer and the commercial lender side. So we think that with our experience in the US with different pricing models, it'll be interesting to see how, in the end, international players are viewing the 4G model within that context. So as an overview, the 3 key models we'll be talking about are the customary demand risk model, which is, simply put, a driver uses a road and pays a toll, and therefore the cost is borne by the user and the government does not pay. The next model, and that's the model that is most challenging, we'll get into more details, but the more challenging model for the private sector. The next model is the availability payment model, where once the project is complete and ready for use, payment is made by a public entity for performance, regardless of demand, regardless of how many people are using the road. A third permutation is the shadow toll model, which is more of a demand risk model, but the payments actually come from the government. So the payments flow to the private sector based on how many drivers there are. However, the payments are not coming from the drivers themselves, they're coming from the public sector. And then the fourth box here is the construction milestone payment. It's more of an add-on structure to either of these 3 models. Like availability payments, the idea is that the government pays because certain construction milestones have been completed, and it helps reduce the cost of capital for the private sector because you have public sector inflows happening during the construction stage. So now we're going to dig a little bit deeper into each of these models. So as I mentioned, the demand risk model is the most challenging model from a private sector perspective because the payments are driven entirely by use of the road. And if there's a road and nobody drives on it, then the private sector is not going to be able to recoup any of their costs. The challenges from the private sector are mitigated to a certain extent by the fact that if the road is driven on extensively, there could be quite a significant economic upside for the private sector. In addition, in a typical demand risk model, there are no performance standards, so the payment flows for the tolls, as long as they can be collected and as long as people are driving, again, go straight to the private sector's pockets. On the challenges, because of the demand risk element, it's really quite rare to see a demand risk model used for a greenfield project. As I mentioned earlier, greenfield meaning it's an asset that doesn't exist previously, and with no history of use of the road, for example, it's very hard for banks and financial institutions to get comfortable with the certainty of the revenue stream in terms, for purposes of having loans paid back. Now, there are ways to mitigate some of these risks, but as I said, it's very, very difficult for these risks to be perfect. in the context of a greenfield project. So we really only see these types of demand risk pricing models used for brownfield projects. You could try a very thorough traffic study, but as tolls are implemented and tolls are increased, that does typically have a negative impact on use. In the concession agreement, it's typical to look for a non-competition clause and make sure that the public sector is not going to build a free road a couple miles down the road and therefore avoid people driving on the tolled road. We've seen this live in a bridge project that we did in Virginia, where we had a client finance a toll with the expectation that there was going to be a tunnel a couple miles down the road that was also going to be tolled. And because of a negative court decision, the tunnel down the road actually could not be tolled. And as a result, you had a tolled bridge with a non-tolled tunnel, so you can all guess where all the traffic was running. You also want to look to restrict the ability of changes in law to negatively impact the ability to collect tolls and build out your project. The other way to try to mitigate the demand risk model risks is to look for a government revenue guarantee. And we'll talk about this more because all those who are familiar with the 4G model will know that that's a key element in getting those transactions banked. And then last but not least is providing for extensions or renewals of the concession to make sure that the private sector has an opportunity to recoup their expected investment. And we thought, do you want to give some live examples, Kent?
Yeah, just to give you kind of a flavor of how demand risk projects have played out in the U.S., there are a couple of sort of war stories that we can share with you. First, to the point about whether demand risk is suitable for greenfield or brownfield. In the case of brownfield, it can go wrong there too. One thing is 100% certain in a demand risk deal, and that is that your traffic study will be wrong. 100% of the time, it is wrong. I can absolutely guarantee that to you. And so as a result, it gives developers quite a bit of latitude to forecast traffic growth and to put a pretty big number up when they're bidding for some of the so-called brownfield assets. Some of you may have followed the Indiana Toll Road project in the U.S. Indiana Toll Road is an interstate highway that runs across the state of Indiana. It was basically concessioned by the state of Indiana in 2006 for about $3.5 billion. The concessionaires for that project, two non-U.S. developers, put a bunch of debt on it and put a bunch of swap and derivative products on it. And the traffic study, no surprise, was incorrect, and so the revenues from tolls weren't sufficient to repay the debt. That project went into bankruptcy earlier this year. And it's sort of a lesson learned that infrastructure financing is not an LBO. There are limits to the amount of leverage you can put on a project that has demand risk in it. Just as an anecdote, and to show how short people's memories are, by the way, despite the problems Indiana Toll Road has had, the winning bidder paid $5.7 billion for it, 34 times EBITDA. So even when things go wrong, there's always somebody out there who's willing to take the big swing at some of these projects. But because of the difficulties with toll projects, what has happened in the U.S. is that they're used now primarily for what are called managed lanes projects. And this goes to Dorina's point about needing to have a track record on traffic. Managed lanes are existing highways where a new lane is built, and then the drivers can pay a toll to drive on that lane. And the rationale is that that lane will have less congestion because people will have to pay a premium to travel on it. Managed lanes projects are regularly financed in the U.S., and there is appetite both in the equity market and in the debt markets for managed lanes. However, you could put far less debt on a demand deal project. The debt to equity ratio for demand risk is around 50-50, maybe 60-40 for a project with a lot of track record and very little capital expenditure needed. And you compare that to, say, an availability payment structure, which Dorina is going to talk about in a few minutes. The debt equity ratio is in the range of 85-15, 90-10. We've even seen 95% debt finance projects with availability payments. So demand risk not only creates, not exactly a chilling effect, but creates obstacles for development. It also has an impact on your flexibility for financing. It's very difficult to get an investment grade rating on a demand risk project with very high levels of leverage because of all the examples of defaults.
And just quickly taking a look at the demand risk model from the public sector's perspective, in many respects this is the best approach from the public sector's perspective because they have no obligations to pay upfront or on an ongoing basis. And they don't take responsibility for CapEx and operations as a practical matter. However, the challenges, we think in many respects, do outweigh, given some of the examples that Kent has just given. The deal execution risk is very high because it is actually very hard to bank a toll road full demand risk project. And then there's always the additional element of potential, the public itself not being happy with the fact that what used to be free roads are now being tolled.
Just a couple of comments on both of those points too. Although those are challenges, I think states have done a very good job in the US in coming up with ways to mitigate those problems. The first, with regard to traffic risk, we're seeing traffic shortfall guarantees or revenue shortfall guarantees becoming much more predominant in the US. For example, there's a deal in North Carolina that closed earlier this year, the I-77 project, which provides a standby facility from the government to provide liquidity to the project if traffic falls below forecasts. On the political risk side, I think that's a question of just education of the public because all of the concessions basically regulate tolls. There is a absolute cap on the amount of tolls that can be charged. So the public, I think, has been misinformed and unnecessarily overexcited about the fact that they're paying more than they should be paying for using the asset.
And they're also just getting used to it as well. Okay, moving on to the availability payment model, which from the private sector's perspective, as we have alluded to on several occasions, is the easiest to finance. The private sector is not going to bear demand or collection risk because they will always have the government having agreed to pay. The challenge, of course, is appropriations risk. In most states in the US, we've seen, in a lot of countries around the world, no government can put in its budget anticipating payments beyond the year at hand. And therefore, the payments, whether they're ongoing payments or if something goes wrong, a termination payment, can't be approved